Hey there guys, and welcome back to the channel. Today I'll be talking about how I balance my portfolios and when I have to sell. These are two very important questions. Ever done a whole ton of research, having full trust in your stock picking skills and seeing your gains mature up to even 100% of a holding? Yes, exactly. I've been there. I know how that feels. You feel very great, but then comes the really tough question. Should I sell? When should I sell? This is always a tough question, and it's very hard to find a pure answer to that. Some people say you have to do a valuation model and you kind of value it yourself, and once you hit that valuation you sell the entire thing. But I'm here to tell you that there are a lot of ways to do it, and I'm going to share with you the way I do it. It's not going to suit everyone's way, but I would like to share with you guys how I would do it. And also it's as I said, this channel is a journal for myself. It's for me to track how I do it in the future, and probably I could refine it even more to improve in the future myself. But back to the story. I had my stock went up 100% and I didn't know when to sell. So I had greed catch me before on a holding that eventually dropped back down, I guess even 90 to 100%, even going into the red at one point. And I could say I have FOMO into not selling. The fear of missing out on future gains caused me to not take profits, not take the gains that I have actually amassed from my stock research. And that was my own fault. And I'm going to show you transparently how I do it. And of course, please do your own research. This is not financial advice. I can't stress this enough. Any resources I use in this video, I will link down below. And please like and subscribe if you enjoyed the video. Now jumping right in. Right, so first thing we have to do is set up our boundaries. I like to determine how I sell based on the boundaries I've set for my stocks and for any of my assets really. So here is a brief look at some of my assets. Of course, the numbers, you can put it in yourself on how much you have it, and of course all of these things are fully customizable. Take it, duplicate it, and play around with it yourself. But I'll just guide you really quickly on what we have to do here. So first, we have to determine the categories, right? So you have cash, you have cash equivalents, you have low, medium, high risk stocks or assets. I keep saying stocks, but I actually mean assets. So high risk assets are, for example, like cryptocurrencies. Medium risk, in my opinion, Malaysian stocks, USA stocks, Singapore stocks. Low would be ASMB, commodities, REITs, cash equivalents, money market funds, and then cash itself, just cash on hand. You always need cash on hand. Cash is king after all, right? And how this portfolio balancing tool works is it's really cool. So every time you go here and you fill up your net worth, I'll come into this a little bit more later. It actually updates here. So you gotta make sure these references match whatever you have here. So for example, net worth B4 means cryptocurrencies is actually pointing to cryptocurrencies itself, B4. So it reflects here. So every time you change something in the net worth, it actually changes this page, which is pretty cool. And basically current is your current amount divided by your total portfolio. That's how you get your current percentage. And based on your current percentage, it calculates it all here, and it should add up to 100% if you've done it all right. So now I'm going to be talking a little bit about the percentages. You would have to determine how much percent you want to allocate to each category. For example, I feel comfortable with 3% cash, 12% cash equivalent. That's almost keeps me at 15% cash. Some people would think this is a little bit too conservative, but I'll explain my reasoning behind keeping around 15% cash at this moment. Then I would be safe with 27% in low risk investments, 46% in medium risk investments, and 12% in high risk investments. And basically what this does for me, it allows me to then kind of manipulate, or not manipulate, that's not a very nice word, but kind of configure my portfolio in a way where I can determine even deeper the subcategories, right? So I broke this down. So 12%, self-explanatory, my only high-risk high-risk assets in my portfolio is cryptocurrency. So it's self-explanatory, it's 12%. Then I move on to my medium risk assets, or in this case, it's actually stocks. So I have my Malaysian stocks, my USA stocks, and my Singaporean stocks. I want to put a heavy emphasis on USA stocks because I trust them. Let's just say that I put 23% here. So this should add up to 46%. So that's how I do it. And this right here should add up to 27, 12, 12, 3 to 3. And what you see happens here is I take the percentage multiplied by the capital. This gives me the expected capital I should have if I really want to hit this targeted 12%. But now you can see my cryptocurrencies is actually falling behind. I'm at 7% while I want it to be at 12%. So you can see the allocation is telling me please increase, and increase by 680 ringgit. So now with that said, I can come here and see, okay, I'm actually 900 ringgit above my expected capital. So I would take every month, I would come here and say, hey, let me take out 900 ringgit, let me take out 460 ringgit, for example, and let me put it into some into crypto, some into USA stocks, and some into ASMB. So that's how I really kind of like measure or balance my portfolios out. Now I'm going to talk a little bit about market conditions, setting scenario boundaries. So remember when I went back here, you could see that actually, how did we get these percentages? How did we derive that? Of course, I said it's up to yourself how you want to derive that, but I actually have a formula and a technique that I do to do that. So as you can see, I have several market conditions here. So when the markets are significantly undervalued, these are my parameters. When they're undervalued, these are my parameters. When they're fair value, so on, so on, so on, right? So now, if you pay close attention, 3, 12, that's 15. This is my current what's it called, probability or percentage, right? This is my boundaries, because I believe that our economy is currently significantly overvalued. Now you can derive market conditions from many indicators. You can even like say how you would like to do it. There are many types of market condition trackers out there. There's the CNN Fear and Greed. There is the market cap to M2 ratio, how much they print in terms of the Federal Reserve. There is even interest rates. You can follow that to see whether you believe the market conditions are high or low, or you can even follow certain gold trackers, for example, the price to gold ratios. But the my most favorite one is the Buffett indicator. I really love using this thing, and I love using the Buffett indicator for several reasons. One, it's because of its simplicity. The Buffett indicator is easy to calculate, understand, make it accessible to a wide range of investors like me. You can also take a look at of it yourself, right? Provides a comprehensive view. It provides a comprehensive view of the valuations by comparing the total market capitalization to the country's GDP, offering an insight into the overall health of the economy, right? Number 3, its valuation metrics. It helps investors like you and me determine whether the market is overvalued, undervalued, fairly valued, or even significantly overvalued, which can help us guide us into making those boundaries that we have set up. Long-term perspective. This offers a long-term perspective. If you're trading short-term, I do not recommend this indicator, because this indicator is meant for long-term perspective investors. Okay? And number 5, endorsement by Warren Buffett himself. Warren Buffett is the greatest, most well-respected investor I know, and personally I see him as one of the founding fathers of fundamental investments and long-term investing. So his endorsements add credibility to its use as a success as an investor, prompts many to pay attention to the metrics he finds useful, which is why we called it the Buffett indicator. Okay? So we can see here, the Buffett indicator actually tells us, there's actually two here. One, which actually adds the total assets of the Feds, and one that ignores it. I tend to use the one with the total assets of the Feds, because this is technically, I would say, a little bit more aggressive in that sense. So we can tell that the ratio is currently at 147.7%. In order to be significantly overvalued, you just need to be over 126%, which we're significantly over actually by 20%, which is quite crazy. That means we're very, very significantly overvalued according to this market conditions. Of course, I do not fully 100% trust this, but it's a very, very good sign. If you're a modest investor like me, you use things that have been vetted and approved by one of the greatest investors out there, right? But based on that, I actually came here and I made this. So if we're in a significantly overvalued market condition, I set the bands, right? So for example, high risk investments are going to be super volatile, and as you know, high risk during significantly overvalued time. So I set it at 12%, which is quite conservative in my opinion. And then you have 13, 15. As we move into undervalued territory, you can see that increase. Same for medium, it should increase over. And then you can see my cash. So right now I'm holding more cash. That's why I said, please wait till I get to this point, because I'm going to explain why I have so much cash, and that is because I want to deploy it when the markets start cooling down and going into value, undervalue, significantly undervalued, etc., etc. But a caveat is even Warren Buffett doesn't know where the stock is going to go, right? This indicator that I just showed you is just an indicator. You need to make your own decisions here. I would love to follow this indicator to the toe, but I have to sometimes make the hunch call to say, hey, we're actually undervalued. I don't feel like we're significantly overvalued. This is your call as an investor, and you have to take the responsibilities of your calls. Now, moving forward to our last and final step, you have to track your net worth. I track my net worth every month and balance my portfolio based on my net worth. So I would come here and I would type, for example, this month, cryptocurrencies are doing very well. I moved up by, let's say, 1,500. Malaysian stocks performed well. I went up a little bit. American stocks did perform well as well. Actually, Singaporean stocks performed well. Let's say S&B stayed the same. Commodities went very well actually this month. So I put 3,000. REITs, let's say dividends didn't pay out, and it actually went down, let's say 1,300. My cash stayed probably the same, probably give it some interest, and cash pretty much stayed the same. So as you can see, that actually reflects here, 15,910, as you can see here. And now it's telling me different things, right? It's telling me, okay, cryptocurrencies, you need to add by 409. You need to sell some of your Malaysian stocks because you're overly exposed there, right? You need to sell some of your ASMB, you need to sell some of your gold, take some money off of your hands as well, and rebalance these things. So that's how I usually tell if I want to rebalance or not. Okay, going back here, I say we check this every month. I checked it every month myself, and that's when I balance. And you have to keep discipline, right? So good balance, not too long to react, and discipline myself not to sell early or late, but follow the rules and guardrails that I set for myself. This is very, very important, because sometimes, you know, Bitcoin, for example, flew to the moon. I wanted to sell really badly, but I stayed disciplined and I waited to the end of the month to balance my portfolio. Okay, So I'm not affected by the price movement. I'm more affected by the balancing factors that I've set myself and the guardrails I set myself. And I see that in the long term, that this strategy actually helped me grow my Nasdaq, my portfolio really significantly, because I was disciplined. I sell when I needed to sell. I bought when I needed to buy. And it's a very, very good guardrail to set for yourself, because to be a very good investor, you have to be a very disciplined investor as well. But of course, everyone has their own preferences. Some people like to trade short term, some people like to trade medium term. I like to trade very long term, so this works for me. So yes, now that brings us to our summary. Let's recap the 3 things I covered. Number 1, we need to set up our boundaries for our assets. Number 2, we have to set up our scenario boundaries. And number 3, we want to track our net worth every month and balance based on how much the portfolio balancing tool tells us to balance, right? So set up boundaries based on your liquid investments. Number 2, set up scenario boundaries. Choose your own way to determine the market sentiment or conditions. I chose the Warren Buffett way, the Buffett indicator. Configure your portfolio boundaries to align with the market conditions. And number 3, which I believe is the most important thing, you want to track your net worth every month and balance. It's good for balancing. It keeps you very motivated when you see it growing. Sometimes you see it slump a bit. It's like some sort of a game. You gamify the investment process, and it's very, very fun. And it allows you to stay disciplined and only touch and balance your portfolios at the end of every month. And most importantly, to grow your portfolio, just keep on investing. Thank you guys for watching, and I hope to see you guys really soon. Bye bye.